The ongoing conflict involving Russia has sent shockwaves through its economy, reshaping nearly every facet of its financial structure and economic policy. This analysis explores the profound consequences of war on Russia's economy, tracing its roots in sanctions, global economic shifts, and internal structural weaknesses. It delves into the war's immediate effects, long-term implications, and the adaptive measures undertaken to navigate an increasingly complex economic landscape. The conflict's initial stages triggered a cascade of economic disruptions. Among the most impactful were the unprecedented international sanctions imposed by Western nations. These measures targeted a wide range of sectors, including energy exports, banking, and technological imports, and aimed to financially isolate Russia by restricting its access to global financial markets. The freezing of over $300 billion in Russian central bank reserves held abroad was particularly consequential, leaving the economy vulnerable to capital flight and inflationary pressures. This severely restricted Russia's ability to stabilize its currency, the ruble, which plummeted to historic lows in the weeks following the war's onset. To counter this, the central bank raised interest rates to an extraordinary 20%, attempting to mitigate the crisis. At the same time, key industries began experiencing severe supply chain disruptions. Russia's dependence on imported technology and machinery became a glaring vulnerability as sanctions curtailed access to these vital goods. The aviation industry, for example, faced operational challenges due to an inability to source essential parts, raising concerns about its long-term viability. The energy sector has historically been the backbone of Russia's economy, significantly contributing to GDP and government revenue. However, the war transformed this strength into a complex vulnerability. Western sanctions sought to curtail Russian oil and gas exports, while Moscow's countermeasures included rerouting trade to Asian markets. Initially, the sanctions delivered a sharp blow. Europe, previously Russia's largest energy market, actively reduced its reliance on Russian gas through diversification and increased imports from alternative suppliers. In response, Russia expanded its trade relationships with countries like China and India, offering discounted energy exports to maintain market share. Although this strategy provided short-term relief, it exposed significant limitations. Building the necessary infrastructure to sustain these new trade routes required substantial investment and time, leaving revenue gaps. Furthermore, the discounted prices strained government finances, highlighting the sector's growing challenges. Sanctions targeting high-tech imports inflicted substantial damage on Russia's industrial and technological sectors. Companies reliant on Western machinery, software, and expertise were suddenly cut off, creating a domino effect across manufacturing, telecommunications, and defense industries. The automotive sector, for instance, witnessed a sharp decline in production as foreign car makers exited the Russian market. Domestic manufacturers struggled to fill the void due to their reliance on imported components. Similarly, the technology sector faced significant obstacles in sourcing semiconductors and advanced electronics, severely hindering innovation and development. The long-term consequences of this technological stagnation are particularly concerning. Without access to cutting-edge technologies, Russia risks falling behind global competitors, potentially stifling economic growth and reducing its influence in critical industries such as artificial intelligence and aerospace. The economic fallout has significantly impacted ordinary Russians, with inflation surging in the months following the conflict's escalation. Rising import costs and supply chain disruptions drove up the prices of essential goods like food and medicine, eroding purchasing power and increasing poverty rates. To alleviate these hardships, the Russian government implemented measures such as price controls on staple goods, increased subsidies for low-income households, and efforts to stabilize the ruble. While these initiatives provided temporary relief, they also imposed substantial costs on the state budget, reducing resources available for other critical areas, such as infrastructure and education. The war has profoundly affected Russia's labor market. The mobilization of troops and the outflow of skilled workers fleeing conscription or seeking better opportunities abroad has created labor shortages in key sectors. This loss of human capital represents a long-term challenge, reducing the economy's productive capacity and innovation potential. Additionally, the exodus of young, educated professionals, commonly referred to as a brain drain, has left significant gaps in industries critical to economic modernization. This trend exacerbates the current crisis and undermines the country's future growth prospects. Despite these severe challenges, Russia has demonstrated some financial resilience. The central bank's decisive actions, including interest rate hikes and capital controls, helped stabilize the ruble. Over time, the currency recovered, buoyed by strong energy revenues and alternative trading arrangements with non-Western nations. The government's focus on import substitution policies, aimed at reducing reliance on foreign goods and bolstering domestic production, has seen mixed success. Progress in sectors like agriculture and pharmaceuticals has been notable, though replicating advanced technologies remains a significant hurdle due to complexity and cost. Russia has also sought to deepen economic ties with nations outside the Western Bloc. Partnerships with countries in Asia, Africa, and the Middle East have provided alternative markets and sources of investment. However, these relationships come with challenges, including limited market size and geopolitical complexities. The war's long-term impact on Russia's economy is profound and multifaceted. Sanctions, technological isolation, and demographic challenges will continue to shape its economic trajectory for years to come. One critical area of concern is the potential erosion of Russia's energy dominance. As the world accelerates its transition to renewable energy, global demand for fossil fuels, the cornerstone of Russia's economy, is expected to decline. This underscores the urgency of diversifying the economy and investing in emerging industries. Furthermore, the conflict has exposed the risks of over-reliance on global trade and financial systems. While efforts to build economic self-sufficiency may yield some benefits, they also risk further isolating Russia from global innovation and capital flows. The human cost of the war, both in terms of population loss and social discontent, will also weigh heavily on the economy. Addressing these issues requires substantial investment in social welfare and workforce development, areas that have historically been underfunded. The ongoing war has fundamentally reshaped Russia's economy, exposing vulnerabilities while forcing adaptations. Although the country has shown resilience in navigating immediate challenges, its long-term outlook remains uncertain. The interplay of sanctions, structural weaknesses, and global economic shifts will ultimately determine the trajectory of Russia's recovery and its role in the world economy. Understanding these dynamics provides valuable insights into the broader consequences of conflict and the resilience of national economies in times of crisis.